Okay. Well, hello, everyone. Welcome to the spring 2021 meeting of the Shadow Open Market Committee. I'm Deborah Lucas, a member of the SOMC. Our topic today is the Federal Reserve's new policy framework. That revised framework, which gives the Fed increased flexibility and allows it to overshoot its 2% target, comes not coincidentally at a time when many other major policy, social, and economic changes are happening. Notably, the US budget deficit hit an all-time record of $1.7 trillion over the last 6 months. Looking forward, forecasts of debt to GDP continue into uncharted territory. Prices are up 2.6% from a year ago, and major corporations are announcing planned price hikes in the face of rising input prices. Although most policymakers tell us that recent price increases are likely transitory, and so not to worry, talk of inflation is everywhere, in the press, on Wall Street, and on Main Street. So today's presentations, which will explore the implications of that new, more flexible framework for the Fed's ability to manage inflation and inflationary expectations, is an especially timely one. We're also thrilled to have Dr. Richard Clarida, Vice Chair of the Federal Reserve, here to talk about the new framework in our second panel session. Just a note on logistics. If you have questions, you should be able to type them into the platform you're on, and the moderators will try to get through as many of them as possible. So now, without any further delay, I want to hand over the floor to Andrew Levin, my esteemed fellow SOMC member, who will be moderating the first panel on inflation and employment in the Fed's new strategic framework.
Well, thank you, Debbie, and it's great to be with all of you today. Even though we're still online, we were reminiscing about last March when we were able to squeeze in one live conference right before the kind of pandemic hit with full force. And we're looking forward to, hopefully in the not too distant future, being able to do that again. But for today, we're really glad to be able to gather online. Before introducing our panelists, I just wanted to refresh your memory about our meeting last June. At that time, Mickey Levy and Mike Bordo and I gave a presentation where we talked about the role of alternative scenarios. Let me just share my screen with you here quickly, and I'll show you what those looked like. So there were 3 scenarios in this presentation we gave last June. The benign scenario was in green, baseline in black, and the dark red was the severe adverse scenario that we were thinking about at the time. As it turned out, the baseline scenario was very close to the one that the median of the FOMC's projection that they released just a couple weeks after our MBR working paper was published. And that really represented the kind of general view at the time of many professional forecasters as well as most FOMC officials. But I think the key point of our paper at the time was that the Federal Reserve needed to be prepared for a relatively wide range of possible outcomes, including some really gloomy ones, but also some where the economy recovered much more quickly. What's amazing, really looking back now, almost a year later, is that the FOMC's latest projections that they just issued a few weeks ago now line up almost perfectly with what we called the benign scenario last June. And so I just want to leave it there for now. I think that the key point of this really is that that it's important for the Federal Reserve to be as clear as possible in communicating its policy strategy and its contingency plans. So what I'm going to do now is introduce Greg Hess. He's going to talk about the anguish and progress of central banking, taking a longer perspective, a little bit longer perspective. So Greg, microphone to you.
Thank you so much, Andy. If you could put the slides up, please, that'd be wonderful. Hopefully we can get the slides up, please. We'll give it just one more second, everyone. Let me begin by just asking everyone just one favor only, which is that you read the paper that underlies the paper that I wrote today. It's a paper by Arthur Burns, who was the Federal Reserve Chair from 1970 to 1978. It was called The Anguish of Central Banking. Next slide, please. So if you can read The Anguish of Central Banking, the Per Jacobson lecture. It was a paper that he wrote just a year after he stepped down from being Federal Reserve Chair. And what's so interesting about his paper, probably threefold. The first is that he describes central banking in extremely fraught language. Anguish is a word typically reserved for a very difficult feeling. Not only that is that he lists a veritable word cloud of economic challenges that the Federal Reserve faced during this time period. And that's everything from the devaluation of the dollar, policy errors, fine-tuning, oil price shocks of the early 1970s. All these things came into play, but he actually believed that these were not the fundamental causes of the great inflation that took place during his watch. Indeed, he believed that it could be distilled down to a couple of things. One was the reliance on the Full Employment Act of 1946, which he relates back to the history of the U.S. both during the New Deal and during World War II, where it was viewed that the government could create jobs and create a full employment economy for long periods of time. And secondly, that there was enormous pressure to maintain maximum employment because of huge social conflict, difficult political conflict, and from the injustices faced by marginalized groups. And if you turn to the next slide, you'll see a couple of quotes that I pulled from his paper, which speak almost directly to some of the things we hear today, including some of the opening remarks that my colleague Deborah Lucas mentioned. I'll just read the first one. The pursuit of costly social reforms often went hand in hand with the pursuit of full employment. In fact, much of the expanding range of government spending was prompted by the commitment to full employment. Inflation came to be widely viewed as a temporary phenomena, or provided it remained mild, as an acceptable condition. Maximum or full employment, after all, had become the nation's major economic goal, not stability of the price level. That inflation ultimately brings on recessions and otherwise nullifies many of the benefits sought through social legislation was ignored. These factors feed into the conversations that we hear today in our newspapers, on our talking heads on television, in the words we read and see each day in a whole host of social media. Next slide, please. Well, in the aftermath of the great inflation, some great lessons were learned. And I don't want to say that central banking is all anguish, because it is also has been connected and created some great progress. And here are some of those pieces that I think need to be noticed. One is that central banks learned that they could take determined and forceful action in key moments to reverse difficult and challenging situation. And nobody taught us that lesson better than Chairman Volcker and his ending of the great inflation. A very difficult, costly time, but one that paved the way for a great deal of prosperity. We learned about the importance of central bank independence, the importance of simple interest rate rules that help describe monetary policy behavior by the Federal Reserve. And more importantly, those simple rules that are encapsulated by a great paper by John Taylor not only help define a language, a very simple, straightforward language to help communicate monetary policy, it also re-emphasized and re-established key concepts about transparency and systematic aspects of policy that which we take as progress in terms of how monetary policy is implemented. And finally, when Ben Bernanke was a governor, he actually put a number out there that said this is the number that the Federal Reserve should target for inflation, and it was 2%. And all those pieces that you can see here were eventually folded into the long-run goals and monetary strategy paper that was been published by the Federal Reserve and has been published annually by the Federal Reserve since 2012. Next slide, please. Of course, since 2013, times have not been perfect in an economic sense. The Federal Reserve, the FOMC, and our U.S. economy has persistently underperformed and had an inflation rate below 2%. So they established 2% as price stability, as using a certain measure, and the Fed has managed to be about 0.7, 0.6 percentage points below that. Real GDP growth has been modest. Real wage growth has been weak, although for a period of time, the rate of unemployment rate fell precipitously down to 3.5% until the recent pandemic. And finally, during this time period, interest rates have remained, the short-term policy rates that we think about, like the nominal Fed funds rate, have been essentially at our effective lower bound for much of that time period, much of which is not necessarily taken into account by simple interest rate rules like those by John Taylor. Next slide, please. So very recently, the Fed has come up with a new framework, and I'll just kind of list the key points. One is that the FOMC has declared that it's going to stay lower for longer, that they are going to delay liftoff of interest rates until a threshold for average inflation has been reached. And not only is it going to be reached, they want to exceed the target for modestly for a period of time in order to keep average and expected inflation at 2%. The FOMC expects not only to overshoot inflation by a modest amount for some period of time, they also plan to keep policy accommodative until maximum employment is reached and inflation is above 2%. And I underline the word expects because it gives them a little bit of room to maneuver should something unexpected happen. Finally, as the final 2 points, you can notice that the FOMC will focus on outcomes-based policy, not on just projections-based policies, and that the FOMC will take a very inclusive approach to thinking and assessing progress towards maximum employment. Next slide, please. Well, there are some criticisms that I'd like to make about the Fed's new framework, but I thought I would try to put them in light of ways that I could make suggestions as to how they could improve upon them. The first one is to just get back to what economists learn first. When you have a difficult problem to think about, you don't always think about economic answers. You think about economic principles. And I think the first economic principles, the first economic principle that I'd like the FOMC to clarify is that if inflation were to be persistently remaining above 2%, say, if it were persistently above by about 0.7, which is about how persistently it's been below 2% for the last number of years. So let's say that inflation was at 2.7 rather than at 1.3 for a long period of time. Would the FOMC plot a course to keep inflation below 2% for some time afterwards in order to keep average and expected inflation at 2%? In other words, is this phenomenon about overshooting inflation going to be symmetrically imposed in terms of undershooting inflation should the Fed persistently overshoot its long-run target? I think that actually speaks very clearly to what are the transparent goals and objectives of the Federal Reserve and the FOMC right now. The second one is the Federal Reserve can do more to make policy more systematic, which means more predictable, more less adventurous, more connected to the real phenomena that macroeconomists believe should drive policies. Since 2008 and the great financial crisis, the Federal Reserve has had a strong reliance on quantitative easing, that is using its balance sheet to buy and sell assets to help implement monetary policy. In a shadow market paper that Athanasios Orphanides and I wrote in 2018, we suggested that the Federal Reserve should do the same thing that it does for the federal funds rate by providing a dot plot and a set of expectations about where the federal funds rate would lie, that the Federal Reserve should do the same thing for quantitative easing, that it should help relate where the balance sheet will be and make that relatable to the underlying economic variables that should drive economic policy. Next slide. The third one is to be more inclusive about inclusivity. Inclusivity is an important goal. In the company that I lead, inclusivity is an essential part of our fabric and our being. But I think at this point, the Federal Reserve has focused all of its interest in inclusivity about unemployment, and that is a very key area where I think inclusivity needs to be focused. But there's also a sense in which inflation does have very differential impacts based on income levels and based on a whole host of other demographic characteristics that I think should be investigated just as much as rates of unemployment should be. For example, I cite papers in there, and these are papers by people like Stan Fisher, the former vice chairman of the Fed, who point to the fact that inflation has a stronger impact on people who are poor, who have fewer choices than it does for people who have more choices, who have access to more innovative goods, who happen to, and people who happen to be rich. So at the same time, the Fed is trying to think about unemployment in an inclusive light. They should also investigate how inflation and measuring inflation in an inclusive light could also be brought into their analysis. And finally, and probably most important, there are times when the Fed might unexpectedly find itself in the anguish zone. The anguish zone I define as a time period when the rate of inflation rises, the rate of inflation expectations rise, either due to an inflation scare, which my former SOMC colleague Marvin, good friend, wrote about many times, or because of a negative supply shock, much like that took place and that generated stagflation in the United States throughout the late 70s and early 1980s. In those situations, the Fed, will quite unexpectedly be in a period where it's got to fight inflation, and it's going to have to choose between what's more important. Is it better in the short run to bring inflation down and to give up on its maximum employment goals, or is it, going to just focus on maximum employment and look the other way, or lessen the importance on tackling inflation or tackling inflation expectations head on? In what I see right now, the Fed may find itself in a very difficult position in changing its narrative. Its current narrative is what I call, let's start inflation now. I call that sin. Right now, the Fed is trying to up inflation and to create, as people maybe outside the Fed might call, try to run the economy hot. The challenge with that is that it runs counter to the whole notion that the long run best way to create maximum employment is to keep prices stable and to keep the long run rate of inflation very modest and very low. In a situation where the Fed faces either an inflation scare or a negative supply shock, it's going to be faced with having to switch its narrative. And switching its narrative, as Chairman Burns found out, became very difficult in a period where maximum employment was, was lexicographically the most important policy policy goal that the country was pursuing at the time. And that's the concern that I have for the Fed. How can they nimbly change the narrative should the ground underneath them change? Thank you.
Sorry, I think that was all muted. Thank you so much, Greg. We'll turn the microphone over now to Mickey Levy and Mike Bordo to talk about the link between inflations and deficits.
Okay. Mike, you're starting us off.
Yeah, okay. Hello, everybody. Can we see the slides, please? Okay, it's going to take a while. Okay. Okay, so our paper is called Do Enlarged Deficits Cause Inflation? The Historical Perspective. Can you go to the next slide, please? Okay, so the current pandemic and massive fiscal deficits and monetary expansion, we think, has a lot of resonance from history. We did an NBR working paper a couple of months ago where we assessed the historic and modern episodes, and we found similar themes of deficit financing and monetary ease associated with inflation. The link between fiscal deficits and inflation are most apparent and pronounced in wartime, but occasionally they occur in peacetime. The subdued inflation that we saw in the decade after the great financial crisis, despite the fact that deficits were high and not as high as today, and monetary ease was pretty high, that may have been more of an exception than the rule. So next slide, please. Okay, so we have a couple of figures here which kind of encompasses all of history. So if you go to the next slide, Okay, this is figure 1. So what we've got here is the debt to GDP ratio for the US and for the UK, going all the way back. For the US, it's back to 1800, and the UK, it's 1800, although we actually have data going back even farther. And so the key thing, the takeaway from this is that there are these spikes that you see in debt ratios, and they tend to occur in wartime. And the only really exception to that is the U.S. at the end, which was a run up in the debt ratio in the 80s, 90s, and today. Okay, let's go to Let's go to figure 2, please. Next slide. Yeah. So here we show inflation. That's the long run record on inflation. It goes way back too. In fact, it goes back a lot farther. It goes back to the beginning for the US and goes for the UK back to 1660. And again, if you look at this, I mean, obviously you don't have time to look at it for long, but you see that inflation tends to spike during wars and recede during peace times. The primary exception is the Great Inflation, which went from 1965 to 1980. So what I'm going to talk about in the next few minutes, is a real race through monetary and financial history. So go to the next slide, please. Okay. Yeah, next slide. All right. So I'm going to talk about previous slide. Come on, there, stop. Okay. So I'm going to talk about some episodes of fiscal deficits and inflation that occurred during war, and a few that occur in peace. I'm doing a chronological survey. I'm going to go real fast. So in the 18th century, there are sort of 3 episodes that I've isolated. The first is Sweden, and the Riksbank, which was the first central bank. Okay, the first modern central bank financed a fiscal deficit during a war with Russia that started in 1745, and then the 7 Years' War, and that led to a doubling of the price level. Second one is the American Revolutionary War. That's a lot more familiar to us. So the U.S. government, the Congress was unable to raise taxes or issue bonds, so they financed 3/4 of government spending by issuing these continentals, which were unbacked bills of credit. And this was an early example of the inflation tax. So they financed three quarters of their spending doing this, and this was associated with a pretty high inflation, about 20% per year. The next one is the French Revolution, which the story is kind of similar. They couldn't either raise taxes or issue debt, and they what they did was they issued these bills called assignats, which were notes backed by the value of seized church properties. And the idea was they were going to be backed, but they weren't. And what they did was issue more notes and kept issuing more of them, and they ended up with a hyperinflation. Then we go to the 19th century, and there are two examples I was going to give you. The Napoleonic Wars, and from 1797 to 1815. And the Bank of England, I'm looking at the UK, the Bank of England suspended convertibility and accommodated short-term treasury bills for the treasury, which was unable to finance the war with bonds and taxes. And their issue, the Banks of England's note issue, led to a 10% inflation, and they financed about 10% of the government spending with seigniorage. What happened was this was a case of a contingent rule that they'd followed the gold standard back then, and that the rule was that you could temporarily suspend and issue paper money and run large fiscal deficits if people believed that you would return after the war. And this is exactly what happened. After the war, they rolled back the note issue, and the government ran large fiscal surpluses. There was a serious recession. The second 19th century case is the U.S. Civil War, which is again very familiar. The federal government suspended specie convertibility in January 1862, and they had the same problem. They couldn't fund the debt. They couldn't pay for the debt with bonds and taxes. So they began to issue these paper money, the greenbacks, leading to a 25% per year inflation rate. And then after the war, they ran fiscal surpluses and retired the greenbacks and resumed convertibility in 1878. This was associated with a controversy about the greenbacks, but I don't have time to talk about. The Confederacy was in much worse shape. They financed 60% of the war with fiat. They had a hyper. Next slide, please. Okay, so this is the 20th century, and there are two big wars, which are most familiar. And in World War I, this involved an unprecedented amount of spending, and this led central banks to accommodate the spending, and they in all the belligerents, they pegged their interest rates low to facilitate financing, and they acted as engines of inflation. In the UK, it was 25% inflation, US 12%, because our war was shorter. And then after the war, several countries, the central powers, had hyperinflations, and several other countries had high inflations. But in the case of the UK and the US, which never left the gold standard, the convertibility was restored by monetary and fiscal retrenchment. So there was tight money and a serious recession. World War II, similar stories as the First War. It was a huge war. The debt ratio expanded to 120%. Fed seigniorage was 24%. The Fed pegged interest rates, both short and long, to aid Treasury financing. Price controls limited inflation to 4.5%. After the war, not because they were afraid of what happened after World War I, of the serious recession, the Fed continued the rate peg and accommodating monetary policy. There was an acceleration in aggregate demand. Inflation rose to 11% per year from 1945 to 1948. Next slide, please. Okay, so I wanted to just discuss two episodes, peacetime episodes of fiscal deficits. The first is the U.S. in the 1930s, after in the recovery of the Great Depression, and in a paper by Eric Leeper and colleagues, they used the fiscal theory of the price level to posit that actually inflation, which was about 10% per year, reflected Roosevelt's unbacked fiscal policy. Okay, now this is in contrast to Friedman and Schwartz, the traditional story, which said that Roosevelt devalued the dollar, and the effects of the devaluation led to an increase in the monetary gold stock and the money supply. The second example I'm going to discuss, and that segues into what Mickey's going to talk about, is the great inflation. But I will look at the UK in some sense because its experience was even worse than ours. So this was an episode of a pretty clear episode of fiscal dominance. The Bank of England was not independent, okay, and it accommodated the fiscal deficit called the public sector borrowing requirement, and they followed a policy called Go Stop in the 1960s. And the idea was you expand the economy to make it grow. And the belief what drove this was the Phillips curve, which said that if inflation goes up, it's not a problem, that its unemployment is much more important to keep it down. And secondly, a theory by Kaldor, a famous economist at the time, who argued that you could actually, expansionary monetary and fiscal policy could increase potential output, could increase growth. So you had the go period, and you'd have rapid growth and inflation. And then, because they're in Bretton Woods, they hit the exchange rate constraint. They had a balance of payments crisis. They ended up getting rescued by the IMF and by us. Okay, and then they had to cut back, and they followed a contractionary policy. And then once the economy cooled down, they did it again. So there's a series of 4 of these go stop episodes in the 1950s and 60s. And then Bretton Woods collapsed. There's no constraint, and all you get is go. And so there's this famous barber boom in 1973. Inflation soars into double digits. The British only start to get out of this mess with a serious currency crisis in 1975-76, and the IMF has to come in and rescue them. So those are my stories. I'm going to shift gears to Mickey.
Okay, next slide, please. Okay, so I'm going to very briefly describe 3 recent episodes. The U.S. Great Inflation during 1965 to 80, when inflation rose dramatically, the post-Great Financial Crisis period where inflation did not go up, and then the current situation. Okay, so following over a decade of extremely low inflationary expectations, very rapid growth in government spending and accommodative monetary policy drove inflation higher. So it's all a story about fiscal dominance, where you had dramatic increases in spending for the Great Society programs in Vietnam War, and the Martin-led Fed that submitted to LBJ's demands, and the accommodative monetary policy generated a significant increase in inflation. We have to keep in mind back then, the Phillips curve absolutely dominated economic thinking, and the lower unemployment rate took absolute priority over inflation. So by the end of the 1960s, inflation had risen to 6% out of nowhere, and inflationary expectations became embedded. Next slide, please. Okay, so we know the 1970s, next slide, please. We know the 1970s was about Fed Chair Arthur Burns, it was a very eclectic approach to previous slide, please. Very eclectic view of inflation that emphasized cost push, demand pull, labor unions, very little role of money, and he favored wage and price controls, and he ended the gold standard. We had a combination of deficit spending and monetary accommodation. And as Greg Hess pointed out earlier, the tentative efforts to constrain inflation were overwhelmed by concerns about unemployment. And as a consequence, this period, the last 4 years of the decade of the 70s, you had over 10% per year growth in nominal GDP generated by the monetary accommodation. And this led to rising inflation, and at the same time, keep in mind there were higher taxes and regulatory burdens. So the result was excess demand that created higher inflation, lack of central bank credibility, and this triggered a currency crisis and stagflation, and it was finally ended by the Fed, led by Chairman Volcker. Next slide, please. Okay, so now once we get beyond, so we went through this period of the Great Moderation, and then when we consider the Great Financial Crisis, let's just jump to what happened. It was a joint venture by the Congress, the Treasury, and the Fed. The American Recovery and Reinvestment Act of 2009 involved $780 billion, or about 4.9% of GDP, in deficit spending, and then the Fed extended its emergency measures and QE after the economy had recovered and was self-regenerating. The Fed maintained its emergency measures and QE, and in fact, QE3 in 2012 was an explicit Fed attempt to lower the unemployment rate. A critical point I would make is that all of the Fed's QEs, the QE2 and QE3, increased bank reserves, but they remained as excess reserves in the financial system, and they did not stimulate the economy. Okay, nominal GDP growth for the decade was 4%. So all of the Fed's attempts to stimulate the economy did not work. So as a consequence, you had 2.25% or modest real growth, and inflation stayed low. Next slide, please. Okay, the pandemic, deficit spending, the legislated deficit spending has exceeded 25% of GDP, far in excess relative to the decline in GDP than was the fiscal stimulus following the Great Recession relative to the decline in GDP. On the monetary front, zero rates, massive QE, purchases of treasuries and MBS, lender of last resort facilities, and the Fed continues to sustain those emergency policies as the economy recovers. The Fed, as we know, in its new strategy, is to prioritize maximum inclusive employment, and it favors higher inflation. And at the same time, the government's very generous fiscal transfers provide income support and spending, but they've also generated saving far in excess of what existed prior to the pandemic. Next slide, please. Okay, the left-hand slide shows that unlike the period following the Great Financial Crisis, M2, that is bank deposits, have soared. They're up 27% year on year, whereas the Fed's QE2 and QE3 in 2010 and 2012-13 increased the monetary base, but it didn't generate an increase in money or aggregate demand. The right chart shows the soaring bank deposits, and another slide that I don't show is personal saving now is about $2.25 trillion, or 10% of GDP, higher than it was before the pandemic. Next slide, please. Okay, so the real risk of inflation now, and whether it's temporary or permanent, depends on whether aggregate demand in the economy is sustained after the economy recovers, as suggested by the monetary and fiscal stimulus. Remember, following the Great Financial Crisis, there was no surge in M2. There was no excess savings. There was no pent-up demand. The banking system was impaired. Now, all the factors seem to be in place for not just the economy to recover as it reopens, but also there seems to be so much stimulus that we have sustained growth in aggregate demand that is the environment for businesses to raise prices and for inflation to go up. We will see. That's where the risks seem to lie. And I would just conclude by saying the Fed's very sanguine inflation outlook is based seemingly entirely on the post-financial crisis environment. It's not based on longer history. It's not based on the strong growth or its models. And I wonder whether the Fed is prepared for higher inflation if its policies actually work to stimulate the economy. Next and final slide, please. Okay, so the conclusions, wartime history of deficit spending and monetary accommodation generate higher inflation. The peacetime deficit spending and monetary accommodation have also resulted in inflation if excess aggregate demand is allowed to persist. And it's usually involved fiscal dominance. And so if in fact the massive amount of monetary and fiscal stimulus actually stimulates the economy and we have sustained stronger growth in aggregate demand, the risks to inflation are higher, and that may prove that the last decade was the exception to the historic link. And I will stop right there, except to underline, we need to really heed the lessons of history. That concludes my remarks.
Well, thank you, Mike and Mickey. It's really fascinating. It's amusing to me when Mike talks about the Continental Congress issuing money is familiar to all of us. I think the truth is history is probably not as familiar as it should be. So thanks to both of you for flagging all this. We just have really 2 minutes for a couple quick questions. If you can bring Greg back on, I think I'll ask Greg one question and I'll flag one question for Mickey and Mike to address. So Greg, my question for you is that over the last 10 years, more or less, the Fed had a commitment to follow a balanced approach to balancing the maximum employment and the price stability. And I think that was intended, actually, going back in the law in the Humphrey-Hawkins Act, those were both important to ordinary people and to working people and to lower income people, to have both price stability and maximum employment, and the Fed was committed to balance it. My question for you is, do you have any idea why the Fed removed that phrase from its latest statement?
I don't. My thinking is that there's a lot of pressure within kind of the political a realm within society in general to emphasize the maximum employment element of the Fed. And it's been there have been prominent economists who've been talking about raising the level of inflation, the core level of inflation, the target level of inflation for quite some time. Some people think that's a good thing. Some people think that's a bad thing. I happen to be one of those people who think it's a bad thing, but I think there are more and more people who think it's a good thing. And that's a concern for me. I think the Fed is pushing the envelope a little bit about saying that, well, this is going to be transitory, this is going to be temporary. In fact, I point to the fact that on Bloomberg, if you watch Bloomberg in the morning, they've actually turned it into a drinking game in the morning, which is kind of a hard thing to do such an early hour in the morning. But it does suggest that that's right. Yeah, even in Chicago time, it's pretty early. But I'll say this, that once the narrative pivots, and lexicographically, maximum employment becomes number one and price stability becomes number two, whereas before it was price stability was what brought you to maximum employment. Once that pivots, it's very hard to pivot back. And I think that's the source of a lot of the anguish that Arthur Burns felt, and hopefully this Federal Reserve, this FOMC knows how to handle better, and I'm sure they do. I'm looking forward to seeing how they do it.
Okay, well, thank you, Greg, and again, thanks a lot to Mike and Mickey. I'm afraid we are in fact out of time now. So why don't I turn the microphone over to two other members of our Shadow Open Market Committee, Peter Ireland and Athanasios Orphanides. Peter and Athanasios, we really appreciate that the two of you are going to be interviewing Vice Chair Clarida. And so I'll step out of the scene and hand it over to the two of you. Thanks.
Thanks, Andy. We just heard a question that could have easily fit into the session, and maybe Peter and I will need to bring this up in a few minutes. I'm going to start by saying that it's a great pleasure to participate in this conversation. And joining me is my fellow SOMC colleague, Peter Ireland. And what we're going to have is that we're going to have some introductory remarks by the Vice Chair. And after that, we will discuss with him some aspects of the framework of monetary policy strategy where we believe shedding some additional light is useful. Now, before I turn the floor, let me say a few words why this is such a fantastic opportunity. And really what I want to point out is that Rich hasn't started thinking and developing policy ideas about the Fed's policy strategy at the Federal Reserve when he started 2.5 years ago. Really, his work goes back to the time he was a bright young academic at Columbia University, where he authored and co-authored numerous articles on monetary policy strategy. And one of them in particular I want to point out was published over 20 years ago, called The Science of Monetary Policy, really highlighting how important it was for monetary policy to be systematic going forward. And what followed, and really the policy approach that the Fed put in place in 2012 very much reflected the principles that Rich and his co-authors already had highlighted were important for monetary policy over 2 decades ago. And this experience is what made Rich to be the perfect person to lead the FOMC's efforts to review its monetary policy strategy, which resulted in the work we saw last year. Now, let me end by pointing out, things change in economic policy. Distilling the lessons from theory to practice is a continuing challenge as the economic landscape is changing. The experience of the past decade is really what led the FOMC to rethink its policy strategy, but still important to see how the basic tenets of lessons from the science are respected. And what I hope we're going to hear from Rich today is how we can reconcile these changes with what we all understood were the basic tenets of the science of monetary policy some time ago. And let me remind everybody, the prepared remarks that Rich had and the slides have just been posted on the Fed's website, so you can find them there. And Rich, the floor is yours.
Athanasios, thank you so much for that introduction. And I vividly remember the first time we met in your office, you had a espresso machine, which I thought was really, really cool because I'd only seen them in restaurants and hotel business class lounges. And we had a good discussion about monetary policy too. But let me get into my prepared remarks, and I look forward to the conversation. So last August, the FOMC unanimously approved a revised statement on longer run goals and strategy. And at our September and December meetings, we made material changes to our forward guidance to bring it into line with the new policy framework. Now, before I discuss the new framework and the implications that flow from it, I'll first briefly review some important changes in the economy that motivated the committee to assess ways we could refine our strategy and tools to achieve and sustain our dual mandate goals in the economy that we operate in today and for the foreseeable future. Perhaps the most significant change in our understanding of the economy since the Fed formally adopted inflation targeting in 2012 has been the substantial sustained decline in estimates of the neutral real policy rate, R star, that's consistent with our dual mandate objectives. The substantial decline in neutral policy rates has critical implications for policy because it leaves central banks with less conventional space to cut rates to offset adverse shocks to aggregate demand. This development in turn makes it more likely that recessions will impart an elevated risk of persistent downward pressure on inflation and inflation expectations that the Fed should seek to offset throughout the business cycle and not just in downturns themselves. Now, with regard to inflation expectations, there's broad agreement, including at the shadow, that achieving price stability requires that long-run inflation expectations be well anchored at a rate of inflation consistent with the price stability goal. The pre-GFC academic literature, including papers I worked on, derived the important result that a credible inflation-targeting monetary policy that is not constrained by the ELB can deliver inflation expectations that themselves are well anchored at the inflation target. In other words, absent a binding ELB constraint, a policy that targets actual inflation in these models delivers long-run inflation expectations anchored at the target for free. And indeed, in the 15 years before December 2008, when the federal funds rate first hit the ELB, a period of time when de facto, if not de jure, the Fed conducted policy that was widely understood to be targeting inflation of 2%, PCE inflation averaged very close to 2%, as is illustrated in Figure 1. But this copacetic coincidence no longer holds in a world of low R star in which adverse aggregate demand shocks drive the economy in downturns to the ELB. In this case, economic analysis indicates that flexible inflation targeting monetary policy cannot be relied on to deliver inflation expectations that are anchored at target, but instead will tend to deliver inflation expectations that in each business cycle become anchored at a level below target. This downward bias in inflation expectations under inflation targeting in an ELB world can in turn reduce already scarce policy space, which can increase the risk of a downward spiral in both actual and expected inflation that we've observed in some other major economies. Two other related developments that have also become more evident than they appeared in 2012 are that price inflation seems empirically to be less responsive to resource slack, and that estimates of resource slack based upon historically estimated price Phillips curves are less reliable and subject to more material revision than we once commonly believed. For example, in the face of declining unemployment rates that did not result in excessive cost push pressure to price inflation, the median of the committee's projection of U star has been repeatedly revised lower from 5.5% in 2012 to 4% as of the most recent SEP. In the past several years of the previous expansion, declines in the unemployment rate occurred in tandem with a notable and to me welcome increase in real wages that was accompanied by an increase in labor share, but not a surge in price inflation. Indeed, this pattern of mid-cycle declines in unemployment, coincident with non-inflationary increases in wages and labor share, has been evident in the US data since the 1990s. I will now discuss the implications of our new framework for the Fed's price stability mandate before turning to its implications for the maximum employment mandate. There are 5 features of the new framework and our fall FOMC statements that define how the committee will seek to achieve our price stability mandate over time. First, the committee expects to delay liftoff from the ELB until PCE inflation has risen to 2% on an annual basis and other complementary conditions consistent with achieving this goal on a sustained basis have also been met, and I'll discuss those shortly. Second, with inflation having run persistently below 2%, the committee will aim to achieve inflation moderately above 2% for some time in the service of keeping longer run inflation expectations well anchored at the 2% goal. Third, the committee expects that appropriate monetary policy will remain accommodative for some time after the conditions to commence normalization have been met. Fourth, policy will aim over time to return inflation to its longer run goal, which remains 2%, but not below. And fifth, inflation that averages 2% over time represents an ex-ante aspiration of the FOMC, but not a time inconsistent ex post commitment. As I highlighted in speeches at Brookings and Hoover, I believe that a useful way to summarize the framework defined by these features is temporary price level targeting at the ELB that reverts to flexible inflation targeting once the conditions for liftoff have been reached. Just such a framework has been analyzed by Bernanke, Kiley, and Roberts, who in turn build on earlier work by many authors, but I'll cite current colleagues Charlie Evans, John Williams, and then Egerton and Woodford, and many others. Now, a policy that delays liftoff from the ELB until a threshold for inflation has been reached is one element of a temporary price level targeting strategy. And starting with our September statement, we communicated that a necessary condition for liftoff is that we actually reach 2% inflation on an annual basis. TPLT with a one-year memory has been studied by Kiley and Roberts and Bernanke, Kiley, and Roberts, and others. The FOMC also indicated that the committee expects to delay liftoff until inflation is on track to moderately exceed 2% for some time. So we don't want this to be one and done, but we want inflation to reach 2% on a sustained basis. Now, of course, what moderately and for some time mean depend on committee's judgment, and they will depend upon the initial conditions at liftoff, just as they do in other TPLT strategies. And the committee's judgment on moderately and for some time will be communicated through the SEP projections of inflation as well as the press conferences. Our new framework is asymmetric, and that is a feature, not a bug. That is, as in TPLT studies, the goal of policy after lifting off is to return inflation to 2%, but not to push inflation below 2%. In the case of the Fed, we've highlighted that making sure that inflation expectations remain anchored at our 2% objective is just such a consideration. I myself follow closely the Fed staff's index of common inflation expectations, which is now updated quarterly on the board's website and is shown in Figure 2 in the paper as a relevant indicator that this goal is being met. Other things being equal, my desired pace of policy normalization post liftoff would be somewhat slower than otherwise if the CIE index at time of liftoff is below its pre-ELB level. And I should point out, as you can see from Figure 2, that at the time of the pandemic, that this index was very close to the 2% longer run objective. Our framework does aim ex ante for inflation to average 2% over time, but it does not make a commitment to achieve ex post inflation outcomes that average 2% under any and all circumstances. But the same is true for TPLT studies I cited earlier. In these studies, the only way in which average inflation enters the policy rule is through the timing of liftoff itself. Yet, as is shown in Table 1, which is copied directly from Bernanke, Kiley, and Roberts 2019, in stochastic simulations of FIRBUS under TPLT with a one-year memory that reverts to flexible inflation targeting after liftoff, inflation does average very close to 2%. The recent model of Mertens and Williams delivers a similar outcome, even though the policy reaction function in their model does not incorporate an ex post makeup element. It delivers a long-run unconditional average rate of inflation equal to target by aiming for a moderate inflation overshoot away from the ELB that is calibrated to offset the inflation shortfall caused by the ELB. Let me now turn briefly to the implications of the new framework for how the committee defines and seeks to achieve its maximum employment mandate. An important evolution in our new framework is that the committee now defines maximum employment as the highest level of employment that does not generate sustained pressures that put the price stability mandate at risk. As a practical matter, this means to me that when the unemployment rate is elevated relative to my SEP projections of its long-run natural level, monetary policy should, as always and as before, continue to be calibrated to eliminate such employment shortfalls, so long as doing so does not put the price stability mandate at risk. Indeed, in our September and subsequent statements, we indicated that we expect it will be appropriate to keep the funds rate in the current range until inflation has reached 2% and labor market conditions have reached levels consistent with the committee's assessment of maximum employment. Moreover, in our December and subsequent statements, we've indicated that we expect to continue our Treasury and MBS purchases, at least at the current pace, until we've made substantial further progress towards achieving our dual mandate goals. Now, let me emphasize, in our new framework, when in a business cycle expansion, labor market indicators return to a range that in the committee's judgment is broadly consistent with its maximum employment mandate, it will be data on inflation itself that policy will react to. But going forward, policy will not tighten solely because the unemployment rate has fallen below any particular econometric estimate of its long-run natural level. Of course, the relevance of uncertainty about the natural rate of employment and the output gap for the calibration of policy reaction functions is a well and long-studied topic in monetary economics that, is illustrated in Figure 3, remains no less relevant today. And of course, an iron rule of presenting a paper, cite your discussants. And so papers published 20 years ago at the Fed by Orphanides and others, and Frank Smets at the ECB, showed that if monetary policy is implemented with a Taylor type rule, then as output gap uncertainty increases, the optimal Taylor rule coefficient on the output gap will be reduced. And if the increase is large enough, it can actually be driven to zero. Moreover, as has been shown in monetary DSG models going as far back as Peter Ireland's work, roughly at the same time, the empirical relationship between labor market slack and price inflation will in general depend on the cyclical properties of markups and labor share. And as I previously discussed, at least over the past 25 years in the US, mid-cycle increases in productivity adjusted wages that occur in tandem with falling unemployment, the wage Phillips curve relationship, have not been passed through to faster price inflation, but have empirically been absorbed in lower markups. And that's an empirical fact. These considerations have important implications for the Taylor type policy reaction function that I consult and that I do consult, which is a version of the policy rule derived in my JEL paper with Gertler and Galley that Athanasios was polite enough to cite. The relevant policy rule benchmark is a simple inertial Taylor rule with a coefficient of 0 on the unemployment gap, a coefficient of 1.5 on the gap between PCE inflation and the 2% longer run goal, and a neutral real policy rate that's equal to my SEP projection of long run R star. I should also note that the Federal Reserve's most recent monetary policy report again features and brings back a box on policy rules, including for the first time a Taylor type shortfalls rule shown in Figure 4, in which the federal funds rate reacts only to shortfalls of employment from the committee's judgment of its maximum level, but reverts to the rule previously described once that level of employment is reached. In closing, I think of our new flexible average inflation targeting approach as a combination of TPLT at the effective lower bound that reverts to flexible inflation targeting once the conditions for liftoff have been met. In this sense, our new framework is an evolution and not a revolution. And I do very much look forward to my conversation with Athanasios and Peter. So thank you very much for your time and attention.
Well, thank you very much, Vice Chair Clarida, both for taking the time to be with us this afternoon and for that really great presentation. Like Athanasios said at the outset, we're going to ask a couple questions of our own, which he and I discussed ahead of time. And we're also going to try and pull some questions from the audience as well. So if you're tuned in, please do use the chat feature to send us some ideas. My question to start builds directly on the last set of issues that you talked about, the asymmetry that's been introduced in the Fed's new strategic framework vis-a-vis the policy response to employment or unemployment. You did a very nice job of laying out the rationale for that response, but I'd like to politely, I hope, push you a little bit harder on those issues. So the asymmetry comes about, as you described, because previously the Fed calibrated its interest rate responses to deviations of employment from the maximum sustainable level, whereas under the new framework, the response is to shortfalls of employment from what is maximally sustainable. Now, in interpreting and in evaluating that change in language, I do think it's worth pointing out that no central banker at the Fed or anywhere else would ever say that it's optimal to raise interest rates for the sole purpose of reducing employment. That would be a perverse monetary policy action, obviously in direct conflict with the Fed's dual mandate. Instead, as I interpreted it, the policy response to deviations of employment from the maximally sustainable level instead reflects the idea that when monetary policy is conducted by managing interest rates must adjust accordingly to keep policy on track given the underlying developments in the economy as a whole. So viewed in that light, the policy response to employment exceeding the natural rate or the maximum sustainable level is not a deliberate tightening intended to derail an economic expansion or recovery, but instead a recognition that when we do see employment in excess of what is maximally sustainable, we worry that monetary policy interest rates have become miscalibrated, that the adjustment is needed to keep monetary policy on track to avoid an overheating labor market and overheating economy, which would then lead to higher inflation down the road, potentially more vigorous corrective action that would have imposed bigger costs on the economy as a whole. So this brings me to my question. The asymmetry, it's not quite the same as, but it's reminiscent of what happens in that old Barrow, Gordon, Killen, Prescott framework, where always trying to push the unemployment rate lower generates an inflationary bias into monetary policy. So my question is, how under the new strategic framework, given this asymmetry in the response to unemployment, do you see the Fed guarding against a reintroduction of that inflationary bias?
Peter, not surprisingly, an excellent question. I'll be concise. I think this really comes down to robustness. My academic career, Clarida, Gertler, and others, was focused on the reality that because of Milton Friedman's long and perhaps variable lags, preemptive monetary policy makes sense in an optimal monetary policy setting. However, monetary policy also needs to be robust, and there's an opportunity cost to acting preemptively as your doubts about the models elevate. Our new framework is not subject to Kidlin-Prescott critique, Barrow critique, Gordon critique. That was a critique where the central bank was so smug, it thought it knew U-star and it didn't care. It was going to keep pushing. We're saying we don't know U-star. We're saying that wage inflation adjusted for productivity that's not passed through to prices is not something that we're trying to guard against. And we'll be attuned and attentive and alert to those pressures. Barrow Gordon was about saying, I think the unemployment rate is lower than the data is indicating. We don't have that. We don't have that view. We have the view that, in essence, if you want to put it in model terms, think about all the models that all of us worked on in our youth. We just have a reaction function because of the ELB. We're going to delay liftoff. We have a reaction function that's basically just feeding back off inflation. And importantly, as I'm sure will come up, I and my other colleagues, not all, have emphasized the importance of monitoring inflation expectations as a reality check on what we're doing. But that would be my crisp answer to your good question.
Excellent, thank you. You mentioned inflationary expectations. I think Athanasios can probably follow up on that.
Okay.
Thanks, Peter. So indeed, I have a question on inflation expectations, and I have to say that looking at the questions from the audience, Anne-Marie Muhlendijk, formerly of the New York Fed, that we all know, actually asks a very, very related question. The question is going to jump off what Peter just said and what you mentioned. We all agree that there are long and variable lags to monetary policy. And this is why 20 years ago we created the consensus that monetary policy should be preemptive. If you are not preemptive, you are outcome-based, you are responding to lags. If you have a framework where the FOMC is stating that it will actually aim to allow for an overshooting of inflation, this is the framework as we understand it, we will be in a situation where we may have inflation above the target for a while, and inflation expectations will start picking up. How would the committee ensure that the pickup in inflation expectations will be checked? So the issue is, what is the role of inflation expectations in the new framework? This has to be something that's separate from the statement that policy is outcome-based, because clearly we don't quite observe inflation expectations, but we do observe measures of inflation expectations, such as the index you just showed us that is updated, the index of common inflation expectations. So at what point would an increase in that index, right now, as I see the update in your paper, it's already at 2%, which is almost 10 basis points up from where it was a few quarters ago. At what point would that dominate and become a concern that would shape policy?
Well, I should have begun, so let me just say what I should have said initially. Of course, I'm representing my individual views. We have 18 members on the committee now. I think inflation expectations are critically important. And the way I think about our framework is, our framework, we needed to evolve because of the ELB. Without the ELB, inflation targeting can get you, so long as you're not too unlucky on the shocks, can get you average inflation around 2%. Indeed, all of our models, we never noticed that all of our models had that property, actually. Mm-hmm. That's what a rational expectations equilibrium is. So average inflation targeting, in essence, is trying to get back close to where we were without the ELB. If we define success that 2% is a ceiling and the ELB is a binding constraint on policy, then it's not advanced PhD coursework to know that inflation is going to average less than 2, and over time inflation expectations will drift down. So that's why policy is, in essence, we're going to be lower for longer and delay liftoff as in other TPLT strategies. And I should point out, as many other central banks in the world, if you look at the communication from the RBA and the Bank of Canada and some other central banks, they're not dissimilar to ours, because we're all facing the same problem. But you ask a good question. So what is the check on or as Rick Mishkin, my good friend and mentor, would say, what is the constrained discretion here? And to me, it really comes down to longer run inflation expectations. We all know that because of shocks, inflation targeting or any monetary policy that we would bless is never going to eliminate all inflation volatility. Inflation itself is always going to move around. And so the metric of success is not zero inflation deviations from 2. The metric of success is longer run inflation expectations well anchored. And that's why I think the staff index is so valuable to me, because it doesn't put all of its eggs in tips or surveys or Stock Watson or models. It looks at 21 different indicators, extracts the common factor. And so just to conclude, speaking for myself, if I were to see that measure begin to drift up persistently and approach a range that I felt was not consistent with that goal, that would indicate to me that policy would need to be adjusted. So absolutely, it's very important to me.
Thanks, Richard. I really appreciate providing this clarity on this point.
On both sides, yes. of 2. And as you know, yes. We can spend time below 2 as well. Yes.
Yeah, absolutely. But this is very important to clarify, because the asymmetry with respect to the maximum employment objective really creates this concern of what will be checking inflation expectations from moving up. Inflation expectations are to move down. Absolutely, we would expect consistent with the framework to have these. Let me follow up on this by pushing a little bit more on what kind of simple policy rules we can think about as reflecting this new framework compared to the old framework. And before I ask the question, we actually thank you and the board for bringing back to the monetary policy report the analysis of simple policy rules. This is quite useful, and indeed, as you're showing in the in Figure 4 of your paper, it's useful to compare what the balanced approach policy would suggest for the federal funds rate to do, which is what the 2012 framework effectively suggests we could do, and compare that with the shortfalls version of the balanced approach. But I'm going to go back and repeat an aspect of the question I asked earlier. All of those rules only depend on outcomes, and there is no role that I can see of for inflation expectations in the simple policy rules that the board is presenting the monetary policy report. Now, obviously, if I actually take the answer to your previous question, suggests that some alternatives might be interesting to look at that somehow also incorporate the way in which policy could incorporate information from inflation expectations. Those would be improvements of the policy rule, but very important, I think, for our frameworks would lead to a better understanding of the new strategy. So is this something that you guys at the board are thinking about doing? Is this something that we can see in the next monetary policy report?
So,
this improved simple
well,
rule?
What I will say is my own thinking on that. I went a little bit more detail, I think, in the Brookings paper, but let me just restate it since you asked. I think there are a couple of ways to do this. One that is attractive to me is to have the degree of inertia post liftoff, because we've all said all these things that we think about, as you know, both of you being insiders at one point, all the things that we look at are always inertial versions of policy rules. So you never take the funds rate from 0 to X in one meeting. There's always inertia. And to me, a very natural way to think about what liftoff looks like as a function of inflation expectations is where inflation expectations are at the time you lift off. If they're close, you perhaps have a lower degree of inertia. If they're not close, if they're below, you return to neutral more slowly. I think that's one way to do it. A simpler way to do it, which I'll plug my own work, Clarida Gertler, you actually are targeting expected inflation minus the inflation target. That's one way to do it too. There was a concern that in certain models that can lead to perverse results, but I think we all understand that for a wide range of parameters, those rules can be stable as well. So there's no unique way to do it, but there are folks on the Fed staff who are thinking and working hard. And I might point out in the footnote to the published paper is a very nice recent piece by John Roberts and co-author as a Fed's note, looking at some simulations of FERBAs with different levels of inertia and threshold. So I'd recommend that to the policy wonks in the audience.
Thanks, Rich. This is indeed a very, very informative answer. I do recall in your work from 20 years ago, you were indeed using expected inflation as an important element in the policy rules. The only issue is that you are using like very short-term, very short-term horizon. If I recall, it was just 1 quarter ahead. Yeah. For a variation that would capture what you're discussing now, I presume that you might want to have some small response in the policy rule from a longer-term inflation expectation that would also not suffer from the stability issues you mentioned.
Oh, sure. No.
Like the CIE, for example, right?
No, in Clarida Gertler, we were as much driven by the instrumental variable econometrics as we were. But no, as a practical matter, I think it makes much more sense to want long-run inflation expectations anchored, 5 to 10 years in the future, and the CI index is a very natural way for me to monitor whether or not that is happening.
Yeah, thanks. That's very good, and it opens up a nice research agenda for people at the Fed and us outside. Peter, I know you have some additional questions that you wanted to ask. Let me turn it over to you.
Thank you. I do. Before moving on, though, let me also say thanks to you and the board staff for making the CIE publicly available now through the board's website. That is a great public service, and it really facilitates both communication and research efforts inside and outside the Fed. That's really terrific.
Yeah.
Let me shift the questioning to another issue. Here I'm kind of aggregating some questions that's come through from the chat, and also returning to an issue that Andy Levin raised in our previous conversation earlier today. The concern that I hear, and this comes through in the chat, it comes through, I'm sure you've heard the concern as well. The concern looking forward is that as we approach the end of 2021 and move into next year, we may, not for sure, but we may see a scenario develop where unemployment remains elevated just because some sectors of the economy are recovering more slowly than others. And yet at the same time, even if we look through what will surely be a lot of short-term noise in the measured inflation data, as we move towards the end of the year, we begin to get the sense that core inflation or trend inflation, call it what you will, is also moving decisively above the 2% target. The key in thinking about this scenario is now the Fed does face a trade-off. Do you keep policy fully accommodative to support lagging sectors of the economy? Or do you begin to renormalize in an effort to stem an incipient rise in inflation? Now, going back to Andy's comment from earlier, the reason why this scenario may be of special concern is another change that was made in the wording of the long-run strategy. Previously, the committee indicated that when this kind of tension arose, the committee would take a balanced approach to dealing with the two sides of the dual mandate. Curiously, much of the wording remains in the statement, but balanced approach has been removed. Can you shed light on?
Yes.
Yes.
Okay. Well, three points. The first is that is a risk case. That's neither our nor private forecasters, Blue Chip Consensus, Bloomberg, Wall Street Journal. That's a risk case, but of course, central banks focus on baseline and risk. There's obviously, a downside risk as well due to the, variants of the virus and other things we don't want to think about anymore after 13 months. But the reality is that we do think there will be some year over year and some base effects and maybe some transitory bottlenecks. But obviously, we're going to be monitoring this very closely. And when we say we don't have good models of U star, that's correct. So we're going to be very attentive to what we're seeing in the nexus between wages, productivity, and prices and markups. Those are all moving around together. What I would say, Peter, and I don't think this is a controversial comment, in any modern economy, including the U.S., in order to get a sustained increase in inflation, you need a sustained increases in wages north of productivity that's being passed through. So I myself will be looking at, compensation and wages and productivity, labor force participation. But clearly, if under that risk scenario, that's something that we would have to respect, and that's something that in our new framework would call for us to think about a potential policy response. Now, to your my third point, maybe it was your second question. On the balanced approach language, you're correct. We left that language virtually intact. It is precisely in there to deal with a supply shock case in which you're in the worst case where you've got too much inflation and too high unemployment. And we still will take an approach that factors in the considerations, the persistence, and the cost benefits of various actions. The only reason we removed balance is that we found that when we did our Fed Listens events, and frankly, when we talked to each other, we had no unique understanding of what balanced approach meant. I mean, there are some folks who think balanced approach means equal coefficients on the variables in your loss function. The other folks who have different interpretations, and so it was merely we kept all the other language in there because we might face that in the future, and we will. And that's one thing from the 2012. Consensus statement that did not change is how we would deal with supply shocks in which unemployment is up and inflation is up.
Thanks. Athanasios, anything else?
Thanks. Absolutely, Peter. So, and I'm monitoring the questions that are coming in. So I will actually pose a question that combines a question I see in the chat by Thomas Hollenberg is asking about the sequencing of tapering. So, and I want to combine this. So sequencing of tapering versus interest rates. I want to combine this with a question that Greg Hess effectively asked in his presentation in the first panel, which is along the following lines. In current circumstances, we know that the short-term interest rate is not a satisfactory description of the stance of monetary policy. We know that the size of the balance sheet and the LSUPs are an important component of that. Right now, more important than the federal funds rate. And one of the questions is, how do we incorporate the two in thinking about the overall stance of monetary policy? This would be one question. Our question is, how do we sequence the two? And the question that Greg's asked is why doesn't the FOMC treat these two instruments in a parallel fashion in its communication? For example, in the SEP, we have very detailed information about what each participant of the committee thinks the appropriate level of the federal funds rate is, but we have no idea what the corresponding appropriate level of the balance sheet is, which makes it impossible for us on the outside to judge the combination of the instruments in the monetary policy stance. So what's the thoughts about that? Any thoughts about improving the communication so we can better understand the overall policy stance?
Yeah, so on the sequencing, Chair Powell has been very clear, crystal clear, that our expectation is that the sequencing will broadly resemble the sequencing in reducing the pace of purchases in the previous Q. No, I'm not using the T word. We're going to reduce the pace of purchases at some point, and that would occur prior to any decision about lifting off, as it did, as you recall, the pace of purchases were reduced in 2014. And then the first rate hike was about a year later. I'm not committing to the year necessarily, but that was the sequencing that would be undertaken. And we've said that we would expect a similar sequencing this time. We have offered guidance in our December meeting and in the subsequent statements that we want to see substantial further progress towards our dual mandate objectives before we would consider slowing the pace of purchases. And so this is going to be outcome based. We're going to be looking at the labor market indicators and the inflation data that come in. I know many of us, including myself, have a baseline that's very robust this year, potentially the fastest growth in 35 years, big declines in the unemployment rate, but that's a baseline. And under our new framework, we want to see actual progress. As we go through the year, the SEP projections and the chair's press conference will provide very valuable and useful information about the committee's thinking about whether or not the actual progress that we've seen fits in to this metric. And so that is the way that we've chosen to communicate it. Of course, we're always looking for ways to improve communications, but right now we're happy with the way that we are communicating the policy on the asset purchases. And I'll just leave it at that.
Well, thanks, Rich. Only I'm going to say that, when I read the way you provide a little bit of forward guidance on the balance sheet, it actually reminds me of how we were providing forward guidance on the interest rate back in the 90s, like 20th century communication on that aspect of monetary policy. And that is so different from the 21st century communication on the interest rate. So I would have expected some discussion on rebalancing the two. That's too much to hope for.
Athanasios, if I could, because it may not have gotten the attention it deserved, we made we didn't take anything away. We added something to the SEP in December that many folks have found quite useful. And what we've been doing now for 15 years is asking committee members the balance of risk, are they tilted to the upside or downside for inflation, output, and unemployment? but it was very cumbersome to actually assemble a time series of those diffusion indexes, the share of the committee, balance of risk to the upside downside. So we now do that, and many Fed observers actually find that quite useful information, since, as you both know, a lot of monetary policy is about risk management, and it's actually quite interesting to see the historical evolution of the balance of risk to GDP, employment, and inflation there. So that was an addition to the SEP.
So thanks, Richard. Great answer, and indeed, I'm very happy that you are adding this material in the SCP. So hopefully next time we have a chance, we're going to see 21st century communication on the balance sheet as well. But I'm going to leave it at that. I see that we are running out of time, unfortunately. So it's 4:30. So I don't know if you have time for Rich for one more question from Peter, and then we can stop. So
of
Peter,
course.
you have the last shot. Thank you very much.
I have the last shot. Well, I'm teaching finance to undergraduates this term, and I can't get away from these questions. And I guess now you suffer from the same fate. I'll try. From the audience, somebody asks, are you at all, do you take any information monetary policy-wise from the froth that we've seen in cryptocurrency markets? Or do you, like me, just see that as an isolated and interesting but somewhat puzzling sector of the financial space?
Yeah, well, all I'll say about cryptocurrencies is that, they're not a store of value. They may or may not be a medium of exchange, and obviously consenting adults can trade them, if they wish. But no, I mean, we do look at a wide range of indicators of financial conditions, but they're the more traditional, bonds, stocks, credit spreads, and the like. And I think that's serving us well, and will continue to.
Fantastic. Thank you. Well, we are just about out of time, so let me take this last chance to thank you again, Rich, for your generosity in speaking with us today and delivering those terrific comments. To wrap things up today, let me now introduce my SOMC colleague, Charles Plosser. Charlie, as most of you know, is former president of the Federal Reserve Bank of Philadelphia and presently a visiting fellow at the Hoover Institution. So, Charlie.
As well, we had the opportunity to listen to a bit of history about this, particularly about the similarities between the inflation of the 60s and 70s, the conditions that surrounded that, and perhaps how they're very similar to the conditions we are seeing today. So I think we ought to be cautious in saying, oh, that can never happen again, and that there's a real risk there. So I think the first panel was a terrific introduction to those issues and discussion. And once again, I want to thank both Greg Hess and Michael and Mickey for those presentations. But most of all, I want to thank Rich for being here with us today as Vice Chair. It's always great to hear from him, and his answers and insights in the thinking at the Fed and the thinking of how he thinks about the new strategy has been most helpful, and we appreciate it very much. On that note, let me thank everybody for coming and listening. We hope you enjoyed it. And on behalf of the FOMC, Manhattan Institute, and all our participants and today, thank you for being here, and we hope to see you again next time. Thank you very much.